Very good to have you on again. So, I mean, no one's saying the small caps are killing it or anything. I mean, they're just not making new lows. Is this, you think, some sort of a middle or longer term base for the Russell?
There's some early signs of that, and really for the market overall. And this isn't a trading call. Obviously, market's under pressure here, and look like to remain so as long as rates continue to point higher, and kind of the level we're watching for the 10-year. As long as the 10-year is above 3.5%, there's going to be trading risk. But with that said, there are some signs that a longer-term market bottom is forming. The most notable silver lining is the fact that the Russell 2000 gauge of small cap stocks held the June low on this most recent late Q3 move to the downside, where the S&P 500 made a lower low. What that indicates to us is that weakness in the cap-weighted benchmarks is masking this improving internal breadth at the bottom-up stock level, which is essentially the near opposite of what you would look to see at a market top. And typically at a market top, S&P 500 makes a higher high, small caps make a lower high, and that's your bearish divergence. So we have the near opposite of that. We've noted that the relative ratio of Russell 2000 versus S&P 500 also improving, typically bullish for all. We found that periods of small cap leadership has been correlated to a rising S&P 500. So add it all up, not out of the woods just yet, but as we kind of discussed last week on the show, Brian, do think an opportunity is forming for the long-term investor.
Is it time to just, I know you've got some individual names, Ari, but is it time to just kind of maybe start to nibble at the Russell 2000 or the SML small cap index now in general?
Again, depending on your time horizon, 6 to 12 months out, I think this is a great time to buy small caps, given these emerging signs of relative strength. If you look at what's driving that, one sector standout within the Russell 2000 are the industrials. It was one of the sectors that made that higher low, so it was a driver of that stock improvement. And it's a group that's really, you're starting to see that strength expand across capitalizations. It's moving up our momentum scores, which captures the breadth of improvement across that sector. So it would be a name like SPX Technologies, which we cover at Oppenheimer with an outperform rating. But even looking at large caps, some of the capital good companies like Cummins also seeing a longer-term trend reversal that I think portends to additional gains over the coming months or quarters.
Let's take a closer look at XPSC, because this is kind of a confusing company only because it's like you see like SPX and you're thinking, oh, it's the S&P 500. This is a Charlotte-based company. They make like HVAC, heating and cooling systems. Used to be called SPX Corporation. To your point, they changed the name to SPX Technology because, of course, that's what you do now. You're no longer a corporation. You're a technology company. SPXC, what are you seeing in this chart, Ari, which is so interesting to you?
Yeah, $2.5 billion market cap. It's covered by Brian Blair at Oppenheimer. And what's the standout in the charts is that it was one of the few stocks that when the market was rallying in the summer, here's a stock that pushed above its 200-day average. So it was an indication of relative strength. Now, during this second leg lower, while some stocks have fallen below their June lows, here's a stock that was able to uphold its 200-day average. So we think that the worst is behind it, that it's consolidating while the rest of the market is falling. That's an indication of relative strength. That 200-day average comes in at around $53. So that's our risk reward. I think as long as you're above $53 support, once market conditions firm, which we do expect looking out through the balance of the year, I think here's a stock that could reassert its uptrend, and we could be talking about new highs above the prior peak at $68. Okay.